Governments can use monetary policy in order to affect economic conditions in a country, just as they can use fiscal policy. The impact is different because the way the actions are undertaken are different. Now, one of the things that I've talked about in a different video is that when we talk about money supply in economics, it is not the same thing as income. So in a sort of normal everyday conversation that one might have, you might say, well, I'm making more money. I got a raise, I'm making more money. That an economist would say, and I would probably use that phrase as well, but what I really should be saying is that I have higher income. When economists talk about money, they are typically talking about a narrower view of what that constitutes. In particular, the money supply that we're going to be talking about here is the amount of currency in private hands, in private circulation. So when we talk about monetary policy, it's a way to change the amount of funds in circulation, the amount of money in circulation, the amount of currency in circulation out in the economy. So talk briefly here about various actions that a central bank can use to influence the money supply. A central bank is the institution in most countries that is really responsible for money supply decisions. In the US, that is the Federal Reserve Board. So the Federal Reserve Board for the United States is our central bank. And so they may take actions to either increase or even decrease the money supply or the money supply growth. Now I want to talk briefly about kind of the general types of money supply actions that a central bank would undertake. One, which is the simplest, is that a central bank would typically be the place that would print money, print the pieces of paper that would be in circulation. So in a sort of old style monetary system, you can crank up the printing presses and push pieces of paper out into circulation. Now, in countries that have central banks that can print money, this is a way for the government to pay its bills. You print a piece of paper, private individuals are typically required to accept that for payments. So this is a way that you can increase the amount of government spending by simply printing the pieces of paper that are then used to pay for those goods and services. That is not typically the way it operates in the United States. The United States does not, the US Federal Reserve Board typically does not print money to alter the amount of funds in the money supply. One of the basic actions that they might take is a so-called open market operation, OMO. Now this is a very obscure sounding terminology. You know, what market? What do you mean by open? What's an operation? This is buying or selling bonds in the private bond market. So if the US Central Bank purchases if the Federal Reserve purchases bonds from the public that is an open market purchase, OMP, here's what they do. They go out into the private bond market, they buy up the bond, and they pay for it with essentially cash that they create out of thin air. So an open market purchase of bonds is a way to inject more funds into the system. So an open market purchase is a way to increase the money supply. So again, let me repeat this. When they take the bond into the Fed, they're essentially writing a check for it. That is now funds, new money that's in circulation, which can be loaned out by banks and so forth. So they've essentially created money by an open market purchase. Now, in the after the Great Recession in 2009, the Federal Reserve Board was taking a set of actions that was called quantitative easing, or QE. Okay, you may or may not have read about this, but quantitative easing was an open market purchase of bonds. That quantitative easing was easing the amount of money in circulation through the purchase of a bond. Now, in the same way, an open market sale of bonds, okay, the Federal Reserve sells the bond to the public and takes in the currency. Now that currency, the payment for the bond, for the sale of the bond, is now no longer in private hands. Funds that are in, dollar bills or checks that are taken in from the public, from private hands and in the vaults of the Federal Reserve aren't part of the money supply. It's not in circulation. It's at the central bank. Okay, so these open market purchases, open market operations are a way to adjust the supply of money. There is also a concept in the United States which has to do with changing what is known as the discount rate. Now, I don't want to go into a lot of detail about this, although it's actually a fairly commonly used action in the Federal Reserve. They basically lower the interest that are charged to banks for funds held at the Fed. That, in essence, can increase the money supply. Again, the details I don't want to go into right now, but a drop in the discount rate would mean that the U.S. money supply would go up, in essence. If there's an increase in the discount rate, the money supply would tend to go down. So these are various ways in which a central bank could potentially increase the money supply. Now, what does that do? Let's just talk about this briefly. If you have a situation where one of these actions causes the money supply, so MS, the supply of money, so this is the amount of currency in circulation, if the money supply rises in the short run, okay, so this is sort of a relatively short time frame, maybe over a couple of years, something like that, you would tend to be associated with nominal interest rates falling. So you can print more money, have more money in circulation. Nominal interest rates may fall, which would encourage more borrowing to, for example, buy a house. Consumers facing lower interest rates could decide to buy a house because it would be cheaper. Firms might expand factories if it was cheaper to borrow. So this increase in the money supply over the short run that results in falling nominal interest rates tends to be expansionary. This would be expansionary policy in the short run. Now, in a separate video, we'll talk about how increasing the money supply can have a different effect over the long run. And let me hold off on making that connection right now. But for our purposes here, these various policies that the central bank can use to increase the money supply will tend to lower interest rates and encourage more aggregate demand for goods and services by making it cheaper to borrow and result in an expansion of the economy. So if the country is in a recession, expansionary monetary policy would be one of the ways to try and counteract the negative impact of a recession.